At Know Your Numbers Accounting, we believe in providing free small business education. So to you large businesses, make sure you watch this video in a small business disguise. We'll provide the mustaches. Today, we'll be talking about the interest coverage ratio. While this may sound like a ratio concerned with how scandalous the news finds celebrities in skimpy swimwear, we promise you it's much more useful. The interest coverage ratio tells you how effectively your company can pay the interest due on its outstanding debt. That means debt still to be paid, not like really awesome debt. Hey! The interest coverage ratio equals EBIT divided by interest expense. Okay. That's a lot of new terms we haven't come across before. Don't panic. EBIT stands for earnings before interest and taxes. Pretty self-explanatory. Next, interest expenses. Almost exactly what it sounds like. Whatever debts you've taken out, you'll need to pay back a certain amount every month, like your mortgage payment. If these interest expenses are not paid, you risk defaulting on your loans, and that's not good business. In order to be a functioning company, much less profitable, you need to be making more than you owe on your debts. So this ratio is a baseline way to measure solvency within your business. Solvency means solving the question, will I go bankrupt? The interest coverage ratio is an important metric for lenders too, because nobody's going to give you more money if you can't pay off what you already owe. Well, unless you're involved in one of those essential oil pyramid schemes, but that's just pity money from your aunt who hasn't heard of interest coverage ratio. Ooh, maybe tell her to watch this video. With your earnings on top and your expenses on the bottom, like some sort of money bikini, a higher interest coverage ratio is going to be what you're aiming for. It's sometimes also called times interest earned ratio, because whatever number you get tells you how many times your earnings can cover your interest expense. So the higher, the better, like hairstyles in the 80s. What does this look like in practice? Say your EBIT for a given month is $50,000 and your interest expenses are $10,000. Divide the two and you get an interest coverage ratio of 5. That's a nice, healthy, teased perm. If, however, your EBIT is $10,000 and your interest expenses are also $10,000, you have an interest coverage ratio of 1. This is a not flattering look. Your earnings are barely paying off your loans. Depending on your industry, anything under a 1.5 or 2 looks pretty risky to investors. Of course, a single ratio from a single month doesn't tell you much. Like most financial ratios and hairstyles, it's all about trends over time. If over the course of a year, your business's interest coverage ratio is increasing, it's an indication that your debt is becoming a smaller percentage of your financial burden. Now that is a good look. If you need qualified advice about your own financial ratios or deeply unqualified advice about styling your hair, contact Know Your Numbers Accounting today for quick, questionably trendy, always accurate accounting services.